This is Nightly Business Report with Bill Griffith and Sue Herrera.
Earnings lift. Stocks rallied for a second day thanks to better than expected earnings from some of the world's biggest and most recognizable companies.
Taxing issue. Do you shop online? Well, the Supreme Court is deciding whether you will soon have to pay sales tax on every purchase.
Partial outage. The IRS website's unexpected message for those last-minute filers. Those stories and more tonight on Nightly Business Report for Tuesday, April 17th.
And we do bid you good evening, everybody. They are some of the bluest of the blue chips. Goldman Sachs, Johnson & Johnson, United Healthcare, and all three reported better than expected earnings first thing this morning, adding to evidence that the strengthening economy is helping to lift corporate profits. It is a narrative that Wall Street has come to expect, and it put investors in a buying mood again today. The Dow advanced 213 points to 24,786. The Nasdaq added 124, driven higher by Netflix and its strong results that we told you about last night. The S&P was up by 28. Dominic Chu breaks down the results from today's Big Three for us.
Yes, this earnings season is still on the young side, but it is the busiest day for earnings of Dow components so far. We'll start with the big bank report. Goldman Sachs, those shares were lower on the day following what was generally perceived as a positive report. The investment banking giant posted better than expected profits and revenue thanks in part to a big jump in the money it made from trading stocks. Goldman also raised its quarterly dividend by nearly 7% to 80 cents per share. Similar story with shares of Johnson & Johnson. The healthcare and consumer products company also reported better than expected profits and sales, boosted by better international business as well as more demand for its cancer-related treatments. Traders, though, were somewhat disappointed that the company did not boost its full-year profit forecast. And then there's United Health Group. Of the three Dow components reporting before the open, the health insurer was the only one that posted a stock gain on the day. Again, profits and sales were better than expected thanks to strength across the board and less money paid out for medical benefits. Unlike Johnson & Johnson, United Health did boost its full-year profit forecast. It may not just be about beating profit and sales expectations. Traders may be looking to see how much more optimistic companies are about tomorrow before bidding prices up for stocks today. For Nightly Business Report, I'm Dominic Chu.
Late today, fellow Dow component IBM reported better than expected earnings, but investors were looking for more. Big Blue earned $2.45 a share, 3 cents better than estimates. Revenue, which has been a sore spot for IBM, grew 5% to more than $19 billion. But it appears as if the company's guidance was disappointing, and that sent the stock initially lower in after-hours trading. Josh Lipton has the one key takeaway from IBM's results.
Big Blue suffering a black eye. Down in the after hours, Lou Misosha, an analyst at Pivotal Research, says gross margins were a problem. 43.7% versus expectations of 45.5%. With 5% revenue growth in the quarter, Misosha says he would have expected IBM to deliver greater operating leverage in the quarter. Still, Misosha is an IBM bull. He was heartened, he said, by the company's so-called strategic imperatives, which include cloud, analytics, and security, jumping 15%. For Nightly Business Report, I'm Josh Lipton, San Francisco.
Now, as strong as stocks have been, commodities have been even stronger this year, with a number of geopolitical tensions apparently causing investors to plow money into many raw materials. Is that momentum expected to continue? And at what point could geopolitical headwinds become a problem for the markets? Joining us tonight, talk about that and more, our friend Art Hogan, Managing Director and Chief Market Strategist at B. Riley FBR. Always good to see you, Arthur.
Nice to see you, Bill.
Those are the headwinds. We also have the tailwinds, which appear to be the earnings, the fundamentals that still are meeting these high expectations for the most part. What do you make of what's been going on here lately?
No, it's interesting. So I think you bring, on the commodity side, you bring up an interesting point. Think about the first quarter of seeing the dollar weaken by about 10%. So obviously a beneficiary is going to be the commodities. And then when you have geopolitical concerns, very much like we saw in Syria, and we saw an 8% move in oil last week, there's a fear of a disruption of supply in the energy complex, so those commodity prices move higher. And then there's that sort of harbor of safety when you plow into some of the precious metals. So I think that's seen some of that bid over the last couple of weeks. I think the dollar equation probably remains the same throughout 2018. I think the geopolitical tensions come and go. So in terms of a consistent pattern in any of the commodity complex, I think you need to be a little bit careful. But I think the strong global growth that we're seeing is going to be a driver as well. So commodities probably have a little bit of runway. But I think the earnings season, the fundamentals here are even better than we thought coming in. Okay. It's one of those quarters where, for the first time in 7 years, earnings estimates went up during the quarter instead of going down, and the beat rate so far with the first 50 companies having reported in the S&P 500 is about 6.5%. We usually beat by about 3.5%. So far, so good, and the response has been very good in the market.
And you know, the economy seems to be firing pretty much on all cylinders, and that's the good news. But it has a lot of people wondering, and we've talked about this the last couple of nights, does it change the opinion of the Fed with the commodity component added into that equation with those higher oil prices?
It's interesting, Sue, because we always hear from the Fed that, at least in the energy complex, that is something that's transitory. They'll look at, the ups and downs in the energy complex and say those prices tend to be transitory. They like to look at inflation as a basket. They look at the PCE. The biggest component in that they'd really like to see pushing inflation higher would be wages. So I think the Fed's on a pretty clear path right now. The language has been pretty consistent. They'd like to raise rates 3 times this year. That's what the market's betting on. At the same time, they're trying to normalize that balance sheet, which is an ongoing process. So we'll see if that becomes a headwind for them to get 2 more done this year. I think the more we see that yield curve tightening, the difference between the 2s and the 10s is going to probably slow them down. If it gets any tighter than what we're seeing right now, I bet they put off raising rates at least the next time until well into the fall.
Along those lines, though, Art, theoretically, as the Fed raises rates, the dollar should be going higher, which would not be good for commodities.
Yes, that's very true, and it's interesting. The conundrum has been, we know exactly what's going on with the Fed. They've been very transparent. We also know that we've got a great deal of issuance this year, right? So between tax cuts and our new budget, we realize how much of a debtor nation we're going to be, how much we have to issue in debt. I think that's what's been weighing down on the dollar. If we just had that one component that you bring up, which is our monetary policy, which is tighter than any other global central bank right now, I think the dollar would certainly be firmer. But I think you look at the country and say, wait a minute, you just spent this much on tax cuts and you just signed a budget. Your deficits are going to be blowing out. Right. I think that's keeping the lid on the dollar in the short term.
All right, Art, always good to see you. Thank you.
Thank you.
Art Hogan with B. Riley FBR.
And to China now, where the world's second largest economy saw growth hold steady amid its trade dispute with the U.S. The Chinese economy grew by 6.8% in the first quarter, which was better than government targets. Eunice Yoon is in Beijing, and she tells us what's fueling that growth.
Cosmetics, clothing, furniture. Chinese consumers were buying more of almost everything, and that helped to lift the economy in the first quarter. Q1 GDP came in at 6.8%. Retail sales were solid and maintained their strength in March, but other data, like investment and industrial output, tapered off. The strong report card is stirring debate here. Barclays believes the strong first quarter gives authorities wiggle room to clean up debt and the environment. JP Morgan and Oxford Economics say expect a slower second half of the year. Capital Economics is skeptical of what it describes as the uncannily stable numbers and believes the economy is cooling down much more quickly than the government is letting on. But they all agree that the biggest challenge for China is a trade war. Even China's statistics official said that global uncertainty is the biggest risk to the economy here, though he said that China is confident that trade frictions won't change the country's stable economic development. And there are signs that trade disruption is looming. In a preliminary anti-dumping ruling, China concluded today that U.S. sorghum is damaging the domestic industry. American companies like CHS will now have to put down a steep deposit for shipments to China, as high as 178.6% of the value of U.S. sorghum imports. The U.S. banned sales of components to Chinese telecoms equipment maker ZTE. And there are reports that the Trump administration is weighing retaliation against Chinese restrictions on high tech, like cloud computing. All developments that add up to greater risk for China's economic outlook. For Nightly Business Report, I'm Eunice Yoon in Beijing.
Now, in a tweet yesterday, President Trump accused China of devaluing its currency, just days after the Treasury Department issued a report that did not label China a currency manipulator. In a CNBC interview, Treasury Secretary Steve Mnuchin tried to clarify, explaining that the president's tweet was in fact a warning.
It was a warning shot at China and Russia about devaluation. China has devalued their currency in the past. Matter of fact, up to through 2016, they devalued it significantly. Starting in 2017, right after the president was elected, they've used a lot of their reserves to actually support the currency. So, you know, the president wants to make sure they don't change these plans, and he's watching it.
On the topic of trade, Secretary Mnuchin said the president's reconsideration of the Trans-Pacific Trade Partnership has nothing to do with China. Instead, he says it's an effort to partner with other countries to further the White House's trade strategy.
Despite a rise in those trade tensions, the International Monetary Fund says the global economy is on track to grow nearly 4% this year. That would be the fastest pace since 2011. The upswing is supported by an increase in investment spending and an acceleration in trade across the globe. But the IMF also warned that an increase in tariffs could reduce global investment and ultimately hurt that growth.
Here in the U.S., the closely watched housing market got some good news and some not so good news today. Housing starts did edge higher last month thanks to an increase in apartment construction. But construction of single-family homes was not as strong, and the housing industry definitely wants to see more building in that area to alleviate a lack of supply, which is driving up prices for buyers. Two popular exchange-traded funds, though, that track the home building sector did both rise on that report today.
Well, it's time to take a look at some of today's upgrades and downgrades. Disney's rating was raised to hold from sell at Pivotal Research. The analyst there says the company appears to be, quote, best positioned among video-centric media companies. The firm does, however, see weak fundamentals overall for the entire industry. The price target is $93. Shares of the Dow component were up nearly 2% to 102.17. Coke's rating was raised to neutral at Goldman Sachs. The analyst there cites improving organic sales growth at the company. The price target is 46. Shares of Coke rose fractionally to 44.88. Bill?
And while upgrading Coke, the same Goldman analyst downgraded its rival Pepsi to sell from neutral. The analyst cited the loss of market share in beverages and limited strategic options in the near term for PepsiCo. The price target, $110. Pepsi stock fell about 1%. To 108.87. Meanwhile, Merck saw its rating raised to overweight from equal weight at Morgan Stanley. The analyst there cited Merck's cancer drug Keytruda, which we told you yesterday has shown great promise in trials. The price target is $68. Shares of Merck rose 1% to 59.27.
Still ahead tonight, the Supreme Court case that could result in you paying more for what you buy online.
Investors paid particular attention today to two stories unrelated to Wall Street. One involved a Southwest Airlines flight from New York to Dallas, which had to make an emergency landing in Philadelphia after an engine failed at about 30,000 feet. Shrapnel from that engine smashed a window, damaged the fuselage, killed a passenger, and injured others. It was the first passenger fatality in a U.S. airline accident since 2009.
The other story is Starbucks. The coffee chain's management will close all U.S. stores and corporate offices on May 29th to train employees against racial bias. This after the arrest last week of two black men waiting at a Starbucks in Philadelphia. The training will close more than 8,000 company-owned stores.
Supreme Court justices today heard arguments in a multi-billion-dollar case that will affect everyone who shops online. The issue is sales tax and whether you'll soon be required to pay it on every single purchase. Ilan Mui is in Washington for us tonight.
The fight over online sales tax went all the way to the Supreme Court today. The case pits South Dakota against internet retailer Wayfair. At issue is whether states can force online businesses to collect sales tax from you, their customers. Currently, companies are only required to do it if they have a physical presence in a state. But South Dakota passed a law in 2016 mandating that almost all online stores collect sales tax. And now the question is before the highest court in the land. The hearing was combative from the start. Justice Sonia Sotomayor said she's concerned about the cost to internet retailers and about overturning a previous Supreme Court decision on this very issue. Justice Ruth Bader Ginsburg was on the other side. She argued that the old ruling is outdated and it's the court's job to fix it. One retail trade group said it's cautiously optimistic for a resolution.
In order to make sure that there's a level playing field, that Main Street retailers and every other retailer are playing by the same set of tax collection rules, it's very important that this court act.
Both sides are providing very different numbers for how collecting sales tax could impact businesses. Estimates of what it would cost a company to comply range from $12 to $250,000. Lost tax revenue is anywhere between $13 billion to $34 billion. Wayfair said no matter what happens at the Supreme Court, it will continue to push for consistent rules and a legislative solution.
There have been several bills proposed to try to solve this issue, but none of them have turned into law. And that's why all eyes are on the Supreme Court. A final decision is expected in June. For Nightly Business Report, I'm Ilan Mui in Washington.
As Elon laid out, that Supreme Court ruling could impact consumers and change the landscape of the retail industry. Joining us to talk about that is Bert Fleckinger. He's managing director at retail consulting firm Strategic Resource Group. Welcome back, Bert. Nice to have you.
Good to team up soon, Bill.
You know, we hear that the court is a little conflicted. There was a lot of back and forth between the justices and the attorneys today. But let's go through the two scenarios. One, that this ruling is overturned. What would that mean for businesses both big and small?
Overturning, Sue, would really help businesses overall because you've had an accelerating retail ice age. Most evidence, as you and Bill reported well, with the bankruptcy and liquidation sale this month of Toys R Us. Mm-hmm. So if you have a level playing field, as Ilan just reported, then you've got retailers investing in growth, hiring, and you actually have more price competition, so it's more competitive and better pricing for consumers overall.
But we did hear that some of the justices were expressing concern about the burden this would put on smaller retailers who would have to keep track of all the various sales tax laws in each state. Now, I know you believe that there's a software package that they can use, but what about the cost involved in the logistics and everything?
In terms of the cost and logistics, in the 1980s, a lot of retailers were complaining that, and vendors in terms of us bringing online debit cards and credit cards to businesses. That was very easy and profitably increased sales. The software is so cost effective and efficient, whether it's the apps developed at Cornell University where I teach or anywhere across the U.S. or the world, that it's very easy for the retailers, and also it'll systemize things so that ultimately retailers can build sales.
And if it's not overturned?
And if it's not overturned, Sue, there'll be economic consequences of epic proportions, where not this year, but in 2019, 2020, you'll see a retail collapse like the 1930s and the Great Depression, or as you and Bill reported well in the financial crisis of 10 years ago. We're already going to have 12,000 stores closed this year, so it'll hollow out retail and hurt jobs, and actually the shoppers and taxpayers will pay more because you'll lose the commercial property taxes, and you'll lose the sales tax, which is a third of all local and state revenue.
Quickly, before I let you go here, a couple of justices mentioned as well, they wonder whether this is even in their jurisdiction. And Ilan mentioned that Congress has brought up a few bills to change that law. Doesn't it belong in Congress? That's where they make laws on taxes.
It does belong in Congress, Bill, but at the same time, Judge Kennedy deserves constructive credit for bringing this to the court, because it was a court decision, as you and Sue reported, 25 years ago on a catalog business that's real retail regression when all this was less than $200 billion. Now it's over $5 trillion, and very important for the economic future viability of retail in the U.S.
Well, we'll know in June, one way or another. Bert, thank you so much.
Keep our fingers crossed for the best.
Bert Fleckinger with Strategic Resource Group. Bill?
Sue, CSX tops expectations, and that is where we begin tonight's market focus. After the bell today, the railroad operator said a decline in operating costs helped profits rise. Company's revenue inched higher as well. Shares of CSX initially popped in the after-hours trading. They ended the regular session up a fraction at 56.57. Also out after the bell tonight, United Continental reported results that improved from a year ago. The company also gave earnings guidance for 2018 that was in line with expectations. Shares of United Continental initially soared in the after hours. They finished the regular session up a tick at 67.34. And Intuitive Surgical, which makes robotic medical devices, reported a rise in profits after the bell today. The company said that strong demand for its Da Vinci system helped the company top expectations. Shares were initially higher in the after hours. They ended the regular session up 4% at $435.45.
Tesla said it was temporarily halting production of its Model 3 electric vehicle as that automaker continues to face manufacturing challenges. Tesla said it wants to address those assembly line issues so it can ramp up production. Tesla shares closed down more than 1% to $287.69. The FDA is optimistic about GW Pharma's experimental epilepsy medication, which is derived from marijuana. The FDA said the treatment, in combination with another drug, was effective at reducing the number of seizures a patient experienced during 3 study trials. The favorable review makes a potential approval of that drug more likely. Shares of GW Pharma jumped 11% to $134.13. And activist hedge fund Starboard Value recently said it was seeking 4 board seats at Newell Brands. Today, Starboard's CEO said the maker of Sharpie markers is undervalued, adding its merger with consumer products company Jarden was a mistake.
It's a great company, great employees. Unfortunately, it lost its way with this merger, and it didn't go as well as it should have. And $10 billion of value has been destroyed since the merger. The company deserves better, the shareholders deserve better, and frankly, the shareholders have asked us to continue in order to try and put some better people on the board and improve the case for change and the case for operational change and improvement at the company.
Shares of Newell Brands rose 4% to $27.37.
Coming up, cyber threats are multiplying fast, and the Department of Homeland Security is outlining its plan of attack. A new European Union proposal would force technology companies to hand over user data to law enforcement officials. The proposal involves data like emails, text messages, and pictures that is stored on servers outside the bloc. Now, officials say the proposed law is necessary because the current legal procedure between countries to obtain electronic evidence takes months.
The Secretary of Homeland Security is focused on cyber threats. The number of attacks is growing, and they're becoming increasingly sophisticated, targeting governments, private companies, and even individuals. Deirdre Bosa reports from San Francisco on the Secretary's plan to strike back.
The Equifax breach, WannaCry ransomware, NotPetya attack, and Facebook's Cambridge Analytica scandal. Last year, nearly half of all Americans had sensitive personal information exposed online as a result of these major attacks. And the threat now spans from government to private companies to our homes and offices. Against this backdrop, the RSA Computer Security Conference here in San Francisco this year kicked off with a keynote from Department of Homeland Security Secretary Kirstjen Nielsen, where she laid out the agency's cyber priorities.
The threat picture is getting dimmer, not brighter. I hate to be the Debbie Downer of cyber conferences, but I begin each morning with an intel briefing that covers everything from terrorist plots to drug smuggling. And I see, as many of you do, that digital threats are multiplying faster than we can keep up in many cases.
She said that her department is adopting a more proactive approach in response to the evolving threat, and that offensive cyber attacks are on the table in talks with other U.S. government agencies. At the same time, a group of more than 30 tech companies led by Microsoft and Facebook signed an accord today that pledged to protect people from malicious cyber attacks. They also vowed not to aid governments, including that of the United States, to carry out cyber attacks, but committed to come to the aid of any nation on the receiving end of an attack. Microsoft President Brad Smith has played a major role in the effort and for years has argued that the world needs a digital Geneva Convention that would set norms for cyberspace behavior.
It pledges us to strengthen defense to protect customers everywhere. It also says we won't help governments launch cyber attacks, as you said, against innocent citizens and enterprises. This is a world where we are seeing some governments do that, and we're taking a principled approach and say that's not something that we want to support.
Secretary Nielsen welcomed the initiative from the private sector, but cautioned against a digital Bill of Rights for citizens, saying it depended on what was in it, but that a digital norm of responsibility is needed. For Nightly Business Report, I'm Deirdre Boza, San Francisco.
Finally tonight, an IRS nightmare on tax day. Wouldn't you know? For the most part of the day, parts of the IRS website were down. Those who tried to pay their tax bill due today directly with their bank account got an error message instead. The agency's acting commissioner just happened to be on Capitol Hill today. He told lawmakers that there were also problems if you were filing with software from H&R Block and TurboTax. But if you are one of the many procrastinators, there is some relief. Treasury Secretary Mnuchin reported late today that those affected will get an extension, and the agency is working to get the site back up and running, we hope.
We certainly hope. Before we go, here's another look at the rally on Wall Street today. The Dow advanced 213 points. The Nasdaq added 124. S&P 500 was up 28. Have you filed?
I certainly have.
I have too, thank goodness.
Yeah.
That does it for us tonight. I'm Sue Herrera. Thanks for joining us.
I'm Bill Griffith. Have a great evening. Get those taxes in. See you tomorrow.